Hi, I'm Chris Mankoff, certified financial planner and partner at GTO Wealth Partners. In this video, I'm going to be picking up where I left off in the previous Roth conversion discussion. We're going over how to use RMDs to cover taxes for Roth conversions, the Pro-Rata Rule you need to know before converting your IRA dollars, the tax treatment of Roth IRA withdrawals, the tax equivalent amounts of distributions, the conversion of after-tax 401k dollars, and the tax benefits of leaving Roth IRA assets to your heirs. So here we're going to take a look at the pro-rata rule. So under the IRS rules, you're not allowed to cherry pick your after-tax IRA dollars for tax-free Roth conversion. So in other words, every conversion must be prorated across all of your traditional IRAs. So in this example, we have two IRAs that are worth $100,000 aggregate, but those IRA accounts had different types of contributions in them. Meaning the first one we see here is a deductible IRA worth $80,000. So we made those deductions or those contributions in there. We were able to offset our tax liability in the years that we made those contributions. In the other account that we see the $20,000 in, when we made those contributions, we weren't able to take any or to receive any tax benefit for making those contributions. So in this example, we want to take that $20,000 and convert it all into Roth dollars. Now, where you're going to run into a problem if you do that is since you still have that one IRA that you receive tax benefit from making those contributions, then that's going to essentially trigger a tax uh, event when you make that $20,000 non-deductible Roth IRA conversion. And so here's how it's going to be looked at. So when we go to do that $20,000 conversion, since we have our total IRA balances of $100,000, 80,000 of that is in our deductible IRA. So in this case, when we make that $20,000 conversion, 80% of that is going to be taxable. So in this case, it's going to be $16,000 of that conversion is taxable. The other amount, which is in our non-deductible IRA, in this case, it's 20%. 4,000 of that total 20 is not going to be a taxable event. So if you want to avoid this pro rata rule, you can simply, assuming that you're still employed and your 401k allows you to do a rollover into that plan, you can simply just take that $80,000 and roll the entire balance into your workplace 401k. And you want to make sure you do this before you convert anything. So that way, that account is closed out, which would leave only the $20,000 on the books. So that $20,000 Roth conversion becomes tax free. So, we can see here that if we take that 80,000 and we go ahead and put it into um, our 401k, then we can avoid that aggregation rule altogether. So that's something you definitely want to take into consideration when you're doing this. And so again, key takeaway here is any Roth conversion must reflect the ratio of your total IRA assets. So by moving your pre-tax, in this example, your deductible IRA into a 401k, that simply just leaves that one non-deductible IRA of $20,000. And at that point, you can actually go in, make the conversion, and that won't be a taxable event. So another thing you want to keep in mind too is when you do this, you have to file IRS Form 8606 in any year that your non-deductible money is added to or withdrawn from the IRA. So this is certainly something that you want to work with either your advisor or uh, your CPA when you do these types of conversions. So that way you can understand the tax implications of making these types of conversions. So we're going to take a look here at a couple of things to keep in mind in regards to the tax treatment of any Roth IRA withdrawal. So the first thing to remember is any contributions that you make to your Roth IRA, you can withdraw totally tax-free and penalty-free. So keep that in mind when you make those contributions. So there are rules that you have to follow that allow for the distribution to be considered qualified. So there is a 5-year rule. So in this case, your Roth IRA has to be open for at least 5 years. A qualifying event can be anything like, being over 59 and a half. If you have a disability, there's a death, or you're using up to $10,000 for a first time home purchase. Now, if your withdrawal is considered or isn't considered qualified, could get taxed and you could get hit with a 10% early withdrawal penalty. So the IRS takes a look at the withdrawals in this order. So, like I mentioned before, any contributions you make are always going to be tax free and penalty free. Outside of that, then they're going to look at the conversion. So that's what's going to come out next. So if there's any conversions under 5 years or age 59 and a half, there's going to be a 10% penalty on that. And then it's also going to take a look at the earnings. So that's going to be taxes income. Like I mentioned before, there's going to be a penalty if it's a non-qualified withdrawal. So something to keep in mind too is the 5-year rule. Each Roth IRA you open has its own 5-year clock. So even if you're 60, your account is only a year old, your earnings could be taxed and penalized if withdrawn early. So we're going to take a look at the 5-year rule here. So when does it start? So the 5-year rule is going to start on January 1st of the year you make your first Roth IRA contribution. So for example, here you open and you fund your Roth IRA in November of 2025. Your 5-year clock actually starts on January 1st of 2025, not the day that you deposited the money. So in this case, your 5-year clock is going to hit on January 1st of 2030. So another thing to keep in mind too is conversions have their own separate 5-year clock. So each Roth conversion you make starts a new 5-year period to avoid the 10% penalty on withholding or withdrawing converted amounts if you're under age 59 and a half. So each time you convert money from a traditional IRA to a Roth, a new 5-year clock starts for that conversion. So this only matters if you're under age 59 and a half. So again, like I mentioned before, if you withdraw those converted dollars before that 5-year period ends, you could owe a 10% penalty, even though those dollars were already taxed when you converted them. So an example here is you convert money in 2025. You'd have to wait until 2029 to withdraw those converted funds penalty free if you're under 59 and a half. So it is important to understand that this rule is separate from the 5-year clock for earnings. So you can meet the 5-year rule for the earnings withdrawals, but still face penalties on recent conversions if you're too young or if you withdraw too early. So what happens if you're over age 59 and a half? The good news is that 10% penalty won't apply to withdrawals after 59 and a half. So you can, in this case, you can withdraw converted amounts anytime, even if the 5-year clock isn't up, so without penalty. However, you still have to keep in mind earnings. So if your Roth IRA itself isn't 5 years old, any earnings you withdraw could still be taxed as income, even if there is no penalty. So an example here is you're 62, you convert funds in 2023, and in 2025, you take money out. There's not going to be any penalty on those converted dollars because you're over 59 and a half, but any earnings still might be taxed if your Roth isn't 5 years old yet. So something to remember is contributions are safe. Earnings are not always safe. So you want to make sure you know the rules before you take any withdrawals. So here we're going to take a look at the tax equivalent IRA distributions here of $10,000. So as we take a look in the 10 to 12% marginal tax bracket, we do see some additional benefit from that Roth distribution, but the benefit really starts to stand out as your income continues to increase and you start to get in those higher tax brackets. So anybody that's in the current highest tax bracket of 37% would need to withdraw 50 to 60% more from a traditional IRA than the Roth just to receive the same after-tax income. So I found this pretty interesting to share because that shows the power of Roth IRA assets and what they can do in terms of helping you out with your tax liability. So we're going to take a look here at a popular Roth conversion strategy that applies for those that are already subject to RMD. So in this example, we're going to take a look at someone that has $1 million in an IRA and they are subject to RMD. So in this case, their first RMD is going to be $37,736. So after, and again, this is assuming that they're in a 24% tax bracket here. And so after tax, they're going to have $28,679. So what we'll take a look at here is, let's say that we want to use all of those dollars to start converting our IRA into Roth IRA assets. So in this case, we're able to actually convert $119,497 into a Roth, and that's going to be at year one. So if we take a look at year five, right, we're going to have a RMD of $26,610. So assuming we're in that 24% tax bracket, we are going to have after-tax dollars of $20,224, which will allow us to actually convert $84,265 of that IRA. And so we can take a look here too, where the growth is after 5 years at a 6% growth rate. Our Roth IRA is now at $615,000, which has surpassed our IRA balance. So to take a look a little bit further, let's go to year 10. In year 10, our IRA balance is only $270,474. Our RMD at that time is going to be $14,620. After tax, of course, assuming we're in the 24% tax bracket, that $11,111 is going to allow us to convert another $46,297 of our IRA. So in this case, our IRA, our Roth IRA balance, assuming that 6% growth, now is a hair under $1.2 million. So this is a pretty neat strategy right here, especially if you are taking RMDs. You don't need the RMDs, and you are looking to shift more of your IRA assets into Roth assets that aren't subject to RMDs, or perhaps you're using this as an estate planning strategy to where those Roth IRA assets are going to be left to your beneficiaries that can take those withdrawals tax-free. This last slide here, we're just going to take a quick look at the after-tax Roth strategy, otherwise known as the mega backdoor Roth. In order to do this, you have to make sure that a couple things are in place to take advantage of this. So the first thing is you want to make sure that your plan allows after-tax contributions. Not every plan or 401k or similar plan is going to allow you to put away money beyond the pre-tax Roth deferral cap. So you want to verify that your plan allows an after-tax bucket. Now, that cap that I mentioned is going to be $23,500 for 2025. Now, if you are over 50, that cap actually is $31,000. And for those that are 60 to 63, that cap is going to be $34,750. So any after-tax contributions are going to be above that limit. So you can potentially invest far more each year. Now, the cap on the total contributions of everything is going to be $70,000. So that's going to be any employee contributions, pre-tax Roth, after-tax, any profit sharing. So that must stay under $70,000 if you're under 50. Now, for those that are 50 and older, that ceiling is raised to $77,500. And for 2025, there's a special provision that if anybody is 60 to 63, that ceiling is actually $81,250. So you want to make sure that you stay within that ceiling. For high earning participants, you want to check the plan to make sure that your plan is meeting all of the applicable tests, or make sure that it offers a safe harbor design to fully utilize the after-tax bucket. And lastly, you want to make sure that your plan allows in-service withdrawals or rollover ability to make rollovers into the plan. So it must allow in-service distributions of after-tax contributions. If it doesn't, then you'll have to wait until you separate from the company, which at that point really undermines this whole mega Roth backdoor contribution. So if you found this valuable, feel free to click like, subscribe on the channel here, drop any comments down below if you'd like me to cover anything in addition to this plan here or what we've gone over. Otherwise, I will try to come back with some more videos. I'm sure there's some questions regarding how does this work with Medicare and all of those other things. So I will try to put something up for you guys to take a look at that. Thanks for watching, and Hope this helped out.